Not surprisingly, Warren Buffett considers a basic principle in his investing philosophy, and that principle is elementary probability. While running the multi-billion-dollar Berkshire Hathaway, he has successfully leveraged his assets over his career to amass a huge network of cash-producing companies. So we should probably take a look. There are a variety of investment styles to choose from. However, Warren Buffett has become known as one of the greatest investors by using a simple approach. Buffett's elementary probability approach keeps his investing analysis simple. He focuses on transparent companies with a wide moat that are easy to understand. However, Buffett also uses a deep value approach which he has perfected. This value approach, combined with a simplified understanding of companies, limits Berkshire's investable companies to those with low PEs, high levels of cash flow, good corporate management, and sustained earnings. As an example of elementary probability, Buffett used this method in 1963 to decide whether he should put money into American Express. The stock had been beaten down by news that American Express would have to cover fraudulent loans taken out against American Express credit using salad oil supplies as collateral. Reportedly, Buffett went and stood behind the cashier's desk of a few restaurants to see whether individuals would stop using American Express because of the scandal. He concluded the mania of Wall Street was not accurate and that the probability of significant damage was pretty low. So he bought a significant amount of stock and has made a good return. As another example, in 1988, Buffett bought $1 billion worth of Coca Cola stock. Buffett reasoned that with almost 100 years of business performance, Coca Cola had generated above average returns on capital in most of its years of operation, had never incurred a loss, and posted a consistent dividend. Positive developments like management spinning off unrelated businesses and then reinvesting in the outperforming syrup business and repurchasing the company's stock gave Buffett confidence that the company would continue to generate excess returns on capital. As of today, Coca Cola has been one of his most simple, stable, and profitable investments. As a last example, in the early 1990s, as an indirect result of the S&L crisis, Wells Fargo stock was trading at historically low level. In Buffett's analysis, he listed what he viewed as the pros and cons of taking a large position in the bank. On the cons side, Buffett noted three major risks. Number one, a major earthquake which might cause clients to stop borrowing money. Number two, the possibility of a severe financial panic that would endanger other highly leveraged institutions. And number three, the fear that the West Coast real estate values would tumble because of perceived overbuilding at the time. On the pro side, Buffett realized that Wells Fargo earned well over $1 billion in pre-tax annually after about $300 million for loan losses. A quick calculation by Buffett that if 10% of its $48 billion of loans were hit by problems and produced losses, the company would roughly break even. Buffett reasoned that a year like that, which is considered a very low-level probability, would not distress the company. And as we can see in retrospect, Buffett's investment in Wells Fargo has been one of his favorites, and he has continued to add to the position. The bottom line, elementary probability, if used properly, can be profitable. So for you all, if you combine simple fundamental probability with stock sell-offs in cyclical markets, you will have a solid approach to making money. So for today, that's ChewDog Charts. Thank you.